Your dream home isn't just about bricks and walls. It's about comfort, love, and the memories you'll create inside it. Buying a home is one of the biggest milestones of life, and it deserves to be a joyful journey, not a stressful one. In this video, I will walk you through the most important things you should know before taking a home loan. From planning your finances to how banks actually decide the loan amount, with a simple story example that makes it easy to understand. Stay with me till the end, because this could save you from costly mistakes and help you step confidently into your dream home. Before you even step into a bank, check your own financial readiness. First, your credit score. It's like your financial reputation, and a higher score can get you better interest rates. Second, plan your down payment, usually between 10% to 25%. Third, follow the 40% EMI rule. Your monthly EMI should never exceed 40% of your net income. That way, you stay comfortable and stress-free. And finally, always have an emergency fund. Ideally, 6 months of expenses, so your loan never becomes a burden in tough times. Now comes the very important question. How much percentage of the property value bank will finance? This brings us to something very important. The loan to value ratio, or LTV. It's simply the percentage of your property's value that the bank will finance. The formula to calculate LTV is simple. It is loan amount divided by property value and multiplied by 100. If your property is worth 1 crore and the bank's LTV is 80%, you will get 80 lakh rupees as a loan. And the remaining 20 lakh rupees comes from your pocket. The higher your contribution, the lower the risk for the bank, and the better your chances of your loan approval. When banks decide how much they can lend on a property, they look at two numbers. The market value, it is the current price your property would fetch in the open market. The registered value, or circle rate, it is the official government value recorded in the sale deed. Here's the key. Private banks usually consider the market value of the property as the key factor determining your eligibility, while government or PSU banks usually consider the registered value as the key factor determining your eligibility. Generally, the market value is often higher than registered value. Private banks have a competitive edge over government banks. In such scenario, private banks are able to lend more to meet the client's requirement. Let's understand this with a story example. Rukmani wants to buy a flat in Paschim Vihar, Delhi. The registered value as per prevailing circle rate is 50 lakh rupees. The bank's valuation is 80 lakh rupees. Rukmani prefers private bank as it can lend up to 75% of the market value. That is a 60 lakh rupees loan. But here's the twist. During registration, the bank will first disburse 90% of registered value of 50 lakh rupees, which is 45 lakh. Once the property is registered, the bank then gives the balance 15 lakh rupees as a top-up loan. In the end, Rukmani gets the full 60 lakh rupees loan, but she contributes 20 lakh rupees from her own pocket. Just a note, Reserve Bank of India, RBI, has set clear limits for banks on LTV. For properties under 30 lakh rupees value, banks can lend up to 90%. Between 30 lakh rupees and 75 lakh rupees, it's usually capped at 80%. And above 75 lakh rupees, the maximum is around 75%. Simply put, the higher the property price, the more you will need to bring in as down payment. If you are planning to take a home loan, here are a few common mistakes you must avoid. Don't take the maximum eligible loan just because you can always borrow within comfort. Don't forget to compare lenders. Interest rates and charges vary. Don't ignore your future income stability. EMIs are a long term commitment. And finally, the most common mistake, please don't overestimate rental income to pay EMIs. Markets change. If this video helped you, please give it a thumbs up, share it with anyone who's house hunting. Please subscribe for more practical financial insights.